Hello guys, welcome to this series of CMA US part 1 where we are discussing section A, and in today's video we are going to discuss about inventory. So inventory is quite huge concept, and that's why we have divided this chapter into two parts. So today we are going to discuss all about inventory management and record keeping. Let's start. So why did this particular chapter comes into the picture? So sometimes what happened that suppose you are the finance manager of a retail company, the prices of the goods have been rising steadily, but at the year end your CEO asked this very question and auditors are simultaneously questioned whether some goods should be included in inventory or not. So that is why the question of inventory tracking methods and inventory record keeping comes into the picture, because they want to know that which of the inventory should be recorded in our books of accounts and which should not be recorded. So the way you value inventory, track it and assign cost directly impacts profit, taxes and every major financial decisions. Why? Because the value of the inventory is why very important for us, because inventory is what is something which is reflecting on our balance sheet. It's an essential part of our current assets. So that's why it's very important to track it properly, to value it properly, and to assign significant and important cost which is associated to it to that inventory correctly. Now let's see first of all, why do we have inventory accounting? So businesses buy goods at different prices over time and sell goods without tracking each exact unit. So without the structure methods, financial reporting becomes unreliable. So what happens, like as we all know that if there is a, suppose I'll take an example of Reliance Mart. If Reliance Mart is there, what is happening? There are a lot of goods are there which is being sold to the customers, and do you have the track that which one is coming first and which one is going out? So they are not actually tracking it correctly, and sometimes there could be a scenario that where they have bought the same product, but 5 months ago it was priced differently, but today it's priced differently. So in order to ensure that our assets are reported correctly, that is the value of the assets are correct, the expenses are recorded correctly. Why? Because whatever goods you sell, the cost of those goods is recorded as what? Is recorded as a cost on our income statement. And also you make a reliable decision. That means, because if your inventory is correctly stated, that means what? Your balance sheet looks fine. The investors will be more able to rely on your financial statements and make a decision whether to invest more in your company or not. So that's why inventory accounting exists. Now what is inventory? Up till now we have been discussing inventory. What is actually inventory? So the goods which are there in your business or which is there in your shop, which is held for the retail purpose, for the resale purpose, that is termed as inventory. So inventory is what? Inventory is the finished goods. That is what we are discussing over here. Because if I take an example of a manufacturer, then for the manufacturer, say I am a manufacturer of this wooden comb. So in that case what will happen? There will be some raw material, there will be some work in progress, there will be some finished goods. Now what is each of this? Raw material means what? The raw woods which we get from the forest, that will be my raw material. Then some of these woods will be there in the machinery which is getting converted into this shaped comb, and maybe some logo is being assigned to it. Then finally when it is packed in a box and it is being ready for dispatch to the customers, that is what the finished goods. So in that scenario we have three kinds of inventory. But for this particular chapter purpose, what do we consider as inventory? We consider inventory as only the finished goods. That means we are considering that we are buying it from someone and selling it off to someone. We are buying it from wholesaler, we are the retailer, and we are selling it off to the customer, so as to make our understanding really easy. Now when we are buying the inventory, what is the journal entry that we should pass? So the journal entry that we pass is debit inventory and credit cash payables. Debit inventory and credit cash payables, because inventory is coming in, so that's why we are debiting it, and in exchange of that what we are giving it? We are giving the cash, or maybe we are just taking it on credit, then we will have the accounts payable. Then how to value the inventory? That means what all things will be included in the value of this particular com. So one will be the purchase price, the price at which I would have bought it. Then freight in, that means any transportation cost that I would have paid on bringing this com in my warehouse. Then insurance in transit, maybe I would have taken an insurance because this might would have been coming from another country, and I don't want the risk of losing this particular inventory, or maybe the risk to bear that loss in case this goods gets lost. So I would have taken insurance. Then any duty fees, any taxes, any handling charges, whatever is being imposed on bringing a particular piece of inventory to my warehouse, that is included in the value of my inventory. So if multiple items are bought together, allocate cost based on relative fair values. Always record inventory at the net discounted price. So what is happening, what the question is, what this particular line is saying, that suppose I have a shop where I sell multiple items. Now suppose I sell this comb, I sell this body lotion, and like I sell these two items, but I'm buying this from the same vendor. So now when I'm buying it, it's coming in the same truck. This is priced at 200, this is priced at 100. Now suppose I have paid 30 bucks for freight. Now suppose I have paid 30 bucks for my freight. So in that situation, what should I do? I should allocate that freight cost in proportion of their fair values. So this is for 20, this is for 200, this is for 10. So I will divide that 30 this freight in cost in the ratio of 2:1. So that's what this particular box, the concept in this particular box is saying. And also always record inventory at net discounted price. The value of this body lotion is 200 bucks, but the value, the MRP mentioned over here is 200 bucks, but the wholesaler is giving it to me for 180 bucks. So I should record it at 180 bucks, not 200 bucks. Then which goods are included in inventory? That means which all will be the goods that are like in the process of selling or maybe already sold, but again we should include it in our inventory. This is very, very important, guys. Please pay attention. So now FOB shipping point, FOB destination, consigned goods, goods on approval, obsolete inventory. Let's understand each very clearly. Now whenever I am selling off the goods to the customer, now suppose I have a customer who is based out of UK and I have to send these 1000 body lotions ka bottle to that particular customer, and the terms of the sale is FOB shipping point. What is FOB? FOB means free on board. Like there is a terminology which is like FOB. So FOB shipping point is the term, is the agreement. So what does that mean? That I have packed these 1000 body lotions in a big carton and I am giving it on the dockyard. Now suppose the dockyard is at Mumbai. I am giving it at the dockyard. That will be my shipping point. So as soon as the goods reach the shipping point, I hand it over to the common courier. Like it's there at the shipping point. From that point of time, the inventory will not be recorded in the seller's books of accounts. It will not be recorded in my books of accounts. It will be recorded in the buyer's books of accounts now. Why? Because the terms and conditions of the sales is FOB shipping point. And what will happen that when it is in the transit, that means when that particular goods are in transit, they are on the ocean or maybe till the point they reach the United Kingdom, that will be considered as that it is in transit. So what will happen? Then it will be considered in the buyer's inventory. So till then it is considered like always, like once it's reached the shipping point, from then onwards it's considered under the buyer's inventory. So that means during transit only, that is from the point till it reaches from my place to their place, it will be under the buyer's inventory obviously. But now suppose the situation is FOB destination. If the terms and conditions are FOB destination, what does that mean? That means up till the point the goods reach the UK, the threshold of that particular customer, till that point that particular goods will be recorded in my books of accounts. That means during transit, when the goods are moving or are on the ocean, during that time that particular body lotion ka bottle will be in my books of account until it reaches the threshold of the, it reaches the doorstep of the buyer, and I hand it over to him, like my delivery guy hand it over to him. One more example of FOB destination: we all buy goods from e-commerce website, from Amazon, Flipkart, Meesho, wherever. So what is there, that if we are buying goods from there, what is happening, until and unless I receive the goods, I tell the OTP to the delivery person. Till that point of time, until I tell the OTP to the delivery person, till that point of time, Amazon will record that particular units of inventory in their books of accounts. As soon as I receive that, I confirm that yeah, I have received it. Then it will be recorded in whose books of account? In my books of accounts. But as you see, during the transit, like suppose I ordered something which is based out of Delhi, so unless and until it reaches from Delhi to Bangalore, suppose if the goods is in transit in Madhya Pradesh, so during that time it is in transit, and where it will be recorded, it will be recorded in Amazon's books of accounts, not in my books of accounts. I hope FOB shipping point and FOB destination is clear to you guys. Moving on to the consigned goods. Now suppose I want to sell these body lotions, but I don't have very good network. So what I do, I just approach someone who is very good at selling, and the person, like suppose I approach Mr. X. He has a very good network of people, and he know a lot of people who are there in the hospitality industry, like they have their cafes, they have their salon, they have their spa, they have their hotels. So I was like, okay, I'll ask Mr. X to sell these body lotions on my behalf to those people who are there in his network, and in exchange I will give him some commission. So when this transaction is happening between me and Mr. X, that is termed as a consignment agreement. So what happens in case of consignment agreement? In case of consignment agreement, this thing happens that this particular inventory will be recorded in my books of accounts, because what is Mr. X doing? He is just taking it from me and he is selling it on my behalf. He is not owning it. This particular body lotion will be in my books of accounts, and once this is being sold by Mr. X to say Hotel Taj, it's being sold to Taj Hotel. In that case, it will directly go from my books of accounts to Taj Hotel's books of account. It will never be recorded in Mr. X books of accounts. Now when this consignment agreement is there, I will be termed as a consignor and Mr. X will be termed as a consignee. So the goods which are there on consignment, so this body lotion which I have given to Mr. X to sell it on my behalf, this will be termed as a consigned goods, and it will be recorded where? It will be recorded on my books of accounts, on the consignor's books of accounts, on the owner's books of accounts, on the seller's books of accounts. The owner, the seller, it is one and the same thing. And over here, these 2 points are very important for us to understand and remember. Now coming to the point number 4, goods on approval. What is happening? That some customer came, to buy this particular comb, and then like the customer, that particular customer is suppose like I sell goods to the salons also in Bangalore. Now suppose one of the salon owners, they came, they bought these 100 units of combs, and I told them that hey, this body lotion is also there, you want this? So he is not sure whether this will be sold in his salon or not. So what he said, I will keep it there for some time on my showcase. If people come and they like this, I will sell to them, otherwise I will return it back to them. So this is termed as a goods on approval. That means the customer is holding it temporarily, they have not purchased it. So they are like, the salon owner is what, like he's not sure whether he's gonna buy it or not. So in that case, that particular body lotion, this particular inventory will be a part of my books of accounts. It will be in the seller's inventory. Okay. Then coming to the obsolete inventory, that means suppose this particular body lotion has been there in my business since 5 years. I'm not able to sell it for XYZ reasons. It has been expired and it's like of no use. It's stinking also. In that case, this is of no use. This is completely useless for us. So what I'm gonna do? I'm gonna write it off immediately, and it's gonna not be there in my balance sheet. So I hope which goods are included in our inventory is clear to you guys. I have highlighted all the important points which is important for us to remember, which should be remembered by us. moving on to the next particular slide. So over here we have the product cost versus period cost. So what is happening, what is there, two types of cost are there, product cost and period cost. Now product cost, as the name says product, that means this cost which is attached to the inventory, and period cost which is attached to the period. What does that mean? Very simple. Product cost means what? Any cost which will be there with the inventory. That means the cost which you have incurred in bringing the inventory to in its sellable condition, or maybe bringing it to the location of sale. So any cost which I have incurred, like suppose this body lotion was like this. I wanted to wrap it in a cardboard box and then I want to bring it to my outlet. So the cost which I am incurring in making a cardboard box for this and also in bringing it to my outlet, in that is termed as a product cost, and that will be an inventoriable cost. It is also termed as inventoriable cost. That will be attached to this particular body lotion, that will stay with this body lotion and will be shown in my inventory on my balance sheet. Coming to the period cost. Period cost is what? It is not tied to the inventory. Now suppose in year 2001, in year 2001, suppose this particular box, this particular inventory, when I just created, like, I just got it, this cardboard manufactured and brought it to my place. During that time I paid salary to my accounting staff. Now the salary which I paid to my accounting staff, does it directly helps me in making that cardboard box and in bringing this particular body lotion in my outlet? No, right? So that is termed as a period cost, and it is, as it is said, it is attached to a period. That means the period, the year in which that cost is incurred, it is again expensed off immediately in our income statement. So that is the difference between the product cost and the period cost. So one last question, the key to understand the difference between period cost and product cost is that whether a cost incurred is necessary to bring the goods to their current condition and location for sale. If yes, it is termed as a product cost. If no, it is termed as a period cost. Okay, so that's what the question you need to ask, whether this cost, the cost which we are incurring, is it helping us to bring this particular body lotion in this condition, and is it also helping me to bring this body lotion to its current place of sale? If yes, fine, then it's a product cost. If not, then it will not, it will be a non-inventoriable cost. Non-inventoriable cost means what? It's gonna be a period cost. Now we have cost flow assumptions. Very easy, very important for us to understand. So we have cost flow assumptions. One is the FIFO, one is the LIFO. That means how do we track the inventory? So basically there are three major methods. One is FIFO, one is LIFO, one is weighted average. Okay. Sorry, not weighted average, actually average method. So we will study this in the subsequent slides. Now, first of all, why do we have this thing? Why they exist? Why do we have cost flow assumptions? Because we purchase goods at various price. We also know that if I am buying this body lotion in the month of January and then if I'm buying it in the month of June, obviously the prices are gonna differ. So that's why we apply a cost flow method, whether it's gonna be FIFO, LIFO or average cost assumption, depending on my goal and maybe how I want to keep my books of accounts. So what we do, we assign to COGS and inventory determines profits, tax and balance sheet value. That means the method which we use, LIFO, FIFO or average cost, that will be what? That will be assigned to my COGS and my inventory. And on the basis of that, my profit will be determined, my tax will be determined and my balance sheet value will be determined. How? When we will see the examples, it will be very clear to you guys. Then one important point, cost flow assumption does not need to match the physical flow of goods. They are accounting conventions only. That means, like suppose if I bought this unit in the month of January and I am saying that I am selling it off, suppose in my books of accounts I am saying I am selling it off in the month of March, that doesn't mean that I have to follow what is there in my book. There could be a scenario that what I have bought later on, that I am selling it off. What I am trying to say is that the purpose of LIFO, FIFO, the method of accounting which we are using is for the accounting purpose only. It's not actually what happening in the real world, like it is not actually the physical flow of goods. Now coming to the FIFO, as the name says, FIFO, first in first out. That means suppose I will start from this way. we'll go ulta, we'll go opposite. So this is the month of January. In the month of January, I bought something for $4. Then the price kept on increasing, and in the month of March, it increased to 9. So in the month of March, when I'm buying 1 unit, that same 1 unit was 4 in the January, but in the month of March, that 4 unit become how much? That 4 unit became 9. Now, as the name says, FIFO, first in, first out. So what came in my business? The first thing came in my business was like these 2 units. So when I am selling it off on my books of accounts, I will show that I am selling off these 2 units. So if I'm selling off these 2 units, so the remaining units from here to here will be what? Will be my ending inventory, and that will go on my balance sheet. So the concept of FIFO says that oldest inventory is sold first and the most recently purchased is remaining in the ending inventory. See, this is the oldest one. This is the oldest one. It is there in my, this is there in my, where? This is there in my, the oldest inventory is going to be sold first. This is going to be my cost of sales. This is going to be my cost of sales or cost of goods sold. And the newest one, these are the newest one. These are the newest one. This becomes my ending inventory. Now, since we are seeing that over here the prices are rising, right? The prices are rising. In the January, the same unit was for $4. In the March, it increased to 9, right? Or like, over the period of 3 months. So what I am doing, what I am gonna do, I am gonna see the impact of these rising prices on my COGS, on my profit, on my inventory. Now, when I'm selling these 2 units, this is my cost of goods sold. This is my cost of goods sold. If I would have sold these 2 units, then my cost of goods sold would have been 18. 9 plus 9, 18. But I am selling the one which has come first in my business. So this is what? 9. If my COGS is not 18 but 9, so my cost of goods sold is lower. Now from revenue, when I reduce the cost of goods sold, I will get the profit. If I am reducing less from my profit, if I am reducing less from my revenue, my profit will be high. If I am having lesser expenses, my profit is gonna be high. So that's what is the impact. Now if my profit is high and my cost of goods sold is lower, then my inventory is higher. Why? Because the ones which are purchased later on at a higher prices, that is going to be there where? In my ending inventory. So, and what are the advantages of FIFO? That higher recorded profit, that means the profits are high because COGS is low, the profit is gonna be high. Then inventory is close to the market value. Why? Because these or which are purchased recently, they will be where? In my ending inventory, in my balance sheet, and they will be where? They will be recorded in my balance sheet, and that's why my inventory is very close to my market value. And FIFO is allowed under both IFRS as well as under the US GAAP. Now, coming to the disadvantages. What is the disadvantages? Since the profit is high, if the profit is high, my tax is gonna be higher. Profit is high, tax is gonna be higher, and also my profit can be overstated. Why? Because as of now, if I see today, if I am not following FIFO, I should record this as my cost of goods sold, 9 plus 9. But since I am following the FIFO method, my this 5 plus 4, 9. 9 is becoming my COGS. So because of that, my cost of goods sold is lower and my profit is becoming higher. So it might result in overstated profit. So in FIFO, what is happening? In FIFO, we can say my profit is overstated, but my balance sheet is what? My balance sheet is more realistic. My balance sheet looks more realistic. Why? Because it reflects the inventory reflects the actual prices which are there in the market. This is the visual illustration given for our understanding purposes. Already I have explained above, that was a better explanation. Now coming to the LIFO. I'll just grab some water. Now coming to the LIFO. So for the LIFO means what? Last in, first out. So that means if you see this example, so this you can see Jan, Feb, March. So what is happening in the LIFO method, that the Jan, Feb, March, but when the store has to sell it in their warehouse, the goods which they have purchased in March, they will keep it newest first in front of the customer, then the one which is being purchased in Feb, and lastly the one which is being purchased in January. So that the goods which are the latest one, the goods which they have purchased recently they are selling off that one. So what is happening in this case? In this case it is happening that newest inventory is sold first and older cheaper layers remain in the ending inventory. That's what is happening. That means the newest one, this the one which I have bought in March, this the customer will buy, and the one which will be remaining, this will be there in my books of accounts. Now what will be the case in this case, LIFO case? So over here if you see again the same example is given, the prices are rising. Since the prices are rising over here and last in is first out, that means these two will be sold first, so my cost of sales will be higher. If my cost of sales is higher, my profit will be lower, right? Because from the sales I reduce my cost of goods sold, or maybe cost of sales, both are one and same thing. So from profit, from revenue or from sales, if I'm reducing the cost of sales or the cost of goods sold, I'll get my profit. If I am reducing more of amount, what will happen? I will have lesser of profit, right? And then comes the beginning inventory, then comes the ending inventory. So my ending inventory will be based out of the old values, right? So my ending inventory will be lower. My cost of goods sold will be higher and my profit will be lower. Now coming to the LIFO layers, each purchases create a separate cost layer, and selling old layers is equals to LIFO liquidation, and it artificially increases profit. So what is happening that whenever you buy one set of goods, when one set of goods is purchased, this is one layer. When one set of goods purchased, this is one layer. When one set of goods is purchased, this is one layer. So in case of LIFO, now suppose if I am selling the goods which is being bought in January, because the Feb and March one has already been sold, so what is happening? This will be termed as a LIFO liquidation. And what will happen? Since the cost which of the one which we purchased in January will be lower, so my profit will increase. So what will happen? It will artificially is gonna increase my profit. Now what are the advantages? Lower taxable income. Why? Because if my cost of goods sold will be higher, the newest one which I bought now during the inflation will be shown as my cost of goods sold. So if my cost of goods sold is higher, my profit will be lower. If my profit is lower, my taxable income is lower, I have to pay less taxes. Then also one advantage is what? Better matching of current cost to revenue. Why? If I am recording, like in the FIFO you saw, we are selling the goods in month of March, but we are selling the goods which I have bought in January, which is cheaper. So the cost and revenue are not of the same period. But in the LIFO, what is happening? What I have bought in March, then and there only I am selling it off. Okay, so that is what one advantage. Then disadvantage is what? That it has some complex record keeping. Why? Because whenever, suppose say in the next month, in the month of April, one new goods I have bought, what will happen when in the month of April one new good I have bought? So then again it becomes difficult for us to track that how to do the sales and everything. Then inventory undervalued on balance sheet. Why inventory is undervalued? Because what is happening if inventory is undervalued? Because we are recording this one, oldest one, so this is the lower price one. See, if you see this example, this one we are recording, right? So inventory will be what? Inventory will be lower value. Just a second, guys. Okay, sorry guys. Yeah, so that's what it is saying, that what is happening, inventory is undervalued. And also this is not allowed under IFRS. LIFO method of accounting is not allowed under the IFRS. Coming to the average cost method. Now when we have the average cost method, so in the case of average cost method, what happens? The results will lie between FIFO and LIFO in terms of COGS and inventory value. That means it will not be more than this. Like if suppose as per FIFO my ending inventory is 1000, and as per LIFO my ending inventory is 1200. So as per average cost method, my ending inventory will be somewhere between 1000 or 1200. So that's what this concept is saying. Now in case of average cost method, there is gonna be two methods. One is gonna be periodic system, one is gonna be perpetual system. So what is happening in terms of periodic system? What is happening? We are following the weighted average method, and in terms of perpetual system, we are following the moving average method. So in the what is periodic, what is perpetual, I think it should be explained. Yeah, it is explained in the subsequent slides. We will discuss it then. But that's what the average cost method is, that we take average price for all the units, and that's how we do the calculation. How, it will be very clear with the help of the examples, and also it's given in the subsequent slides. So the average cost method smooths out the price fluctuations, making it a practical middle ground approach for businesses with large volumes of similar items. Because we saw in the LIFO FIFO, either we are taking the one which we have bought initially, or maybe the one which we have bought currently. That's what is happening. So because of that, either my income statement is becoming overstated, or my balance sheet is becoming overstated. That's what is happening. But that is not the case in case of average price, because it is smoothing out the price, and it's spreading the price across the period, so that the cost of goods sold and maybe the ending inventory is also fine. Now, the effect of methods of the, like, what will be the effect, the rising prices, or maybe when it is the falling prices. When the prices are rising prices means what? Inflation. When the prices are falling, that means what? Deflation. I'm just telling you guys, so that in examination, if you get something like that, you people are not getting confused. So inflation means what? Prices are rising. Deflation means what? Prices are falling. So now, if the prices are rising in case of FIFO, we already know that goods will be what? The inventory will be valued high, because now suppose something we bought in the month of January, that is cheaper, and something I bought in the month of March is more expensive. So the one which is being sold in which is being bought in January, that will be sold, so that is the cheaper one, and the one which is being bought in March, that will be the expensive one. So that's why the March one will go in my balance sheet as my ending inventory, and my inventory will be higher. The one bought in January, that will be cheaper, and that will go where? In my cost of goods sold. So if my cost of goods sold is lower, what will happen? My profit is gonna be higher. Now coming to the LIFO, in the case of LIFO, what will happen? The one which I bought in the month of March, what will happen? That will go as my cost of goods sold. So my cost of goods sold will be higher, and the one bought in January, that will be what? That is cheaper. So that will be where? That will be there in my inventory. And what will be my profit? My profit will be lower. Then coming to the case of the falling prices, like suppose the prices are declining, so the one I bought in January is more expensive, the one I bought in month of March is gonna be cheaper. So what is gonna happen in case of FIFO, first in first out? So the one which I bought in January, that is gonna be recorded as my cost of goods sold, and because of that my profit is gonna be lower. So the one which is there in the month of March, that is cheaper, and it's gonna be there where? In my ending inventory. Similarly the case for falling prices, that means for LIFO method, so what will happen? Last in first out. So January was one is expensive, March one is cheaper, so the one bought in March is cheaper, so my cost of goods is lower. If my cost of goods sold is lower, my profit is gonna be high. The one bought in January, it is more expensive, so it's gonna be where? It's gonna be there in my inventory. Now coming to the okay guys, now coming to the periodic versus perpetual inventory system. So in the periodic system, what will happen? First of all, we will calculate the average at the end of the period, that means at the end of the year. So there will be just one average cost. On the basis of that, we'll calculate our cost of goods sold, and we'll calculate our ending inventory. Whereas coming to the perpetual system, what will happen in the perpetual system? In the perpetual system, the average cost is updated after each transaction, after each purchases are made. So what is happening? In case of FIFO, and like suppose if we are following the average method, so if we are following the FIFO, so what is happening? That the same results you will get for the ending inventory and cost of goods sold in both of periodic and perpetual method. Whereas coming for the LIFO, in the LIFO there will be separate answers, like separate numbers you will get for COGS and ending inventory if you follow the periodic and perpetual method. So in the case of LIFO, what will happen? in case of LIFO, in the case of periodic system, first of all, if I take the case of the periodic system, so again, if you follow the FIFO or LIFO, it's gonna be the same only. Like for the first in first out method, the one which you have bought in the month of March, that will be there in your ending inventory, whereas in case of LIFO, the one which you have bought in the month of January, that will be there in your balance sheet. Coming to the perpetual system, in the perpetual system you will get the same answer as the FIFO, but for the LIFO, what will happen, there will be layers. So how it will be cleared, we'll see the examples of LIFO, FIFO with both periodic and perpetual method, so our concept will be clear. One thing we should always remember, in the weighted average, one period average should be there. For the moving average, it calculates average after each purchases. Now in the case of periodic, what is happening, inventory count is done at the end of the period. Inventory count is done at the end of the period. Okay, inventory count is done at the end of the period. In case of perpetual, inventory count is done after each transaction. Then in the case of FIFO, what is happening, in case of periodic, the newest purchases will be there in your ending inventory. In case of LIFO, the oldest purchases, that is the one which you bought in the month of January, that will be there in your ending inventory. And in case of weighted average, one average for the entire period. Coming to the perpetual, you will get the same result as periodic. In the LIFO, this is a complex process because you have to continuously track your inventory. Now coming to the moving average, so what will happen, there will be new average after each and every purchase. Now we have the examples. We have the examples for our FIFO, LIFO, periodic and perpetual. Okay guys, so let's start with our examples. So we have actually here 4 to 5 examples. So first of all is the easiest one, which is related to the FIFO, and here we are gonna discuss about the FIFO method of accounting under both periodic and perpetual. So now what is happening, as I told, in the case of perpetual system, in what is happening, after each and every transaction we are gonna do what, we are gonna revise our inventory records. But in case of periodic, what is happening, once a year, at the end of the year, we are going to stand and we are going to do what, revise our books of accounts. So over here we have been given what, different dates and different amounts of different kinds of transactions, and the amounts is given over here. So that way we have to do what, we have to do the accounting for this and calculate the cost of goods sold and ending inventory under the FIFO method of accounting. Same data will be there for rest of the examples as well. So let's start. So first of all, it's given for the month of April. In the month of April, our beginning inventory was 500 units and the cost of each inventory was rupees 10. So what is the total cost added? The total cost added is 500 into 10 is 5,000 bucks. Then what is the inventory balance on that day? The inventory balance means how much inventory is there in my warehouse, 500 units. What is the value of that 500 units? It's 5,000. And which layer is this? This is the first layer of my inventory. This way I have written down layer 1, layer 2, layer 3. So whenever a new layer is being added, that means whenever a purchase has been made. Now coming to the purchases. Purchases means what? A new layer has been added. So that becomes layer 2. So what is happening? We have bought 500 units at the cost of 12 each. So what is the total cost? So the total cost will be 500 into 12. That will become 6,000. That will become 6,000. What is the inventory balance? This 500 was initially there. We've bought 500 more. So the inventory units balance becomes 1,000. Then what is the inventory value balance? Inventory value balance will be 5,000 plus 6,000 will become 11,000. And how many layers are there? Layer 1 and layer 2. Layer 1 is at the 1,000 bucks and layer 2 is at the layer 1 is at the 1,000 bucks, layer 2 is at the 6,000. Yeah, so that's what it becomes. So layer 1 and layer 2. Oh sorry, I just highlighted the incorrect one. Yeah, layer 1 500 units at the rate 10 each, layer 2 at 500 units at the rate 12 each. Now coming to the sale, when we are selling it off, since this is the case of FIFO, first in first out, so even if it is, if say suppose it is the periodic method, so in case of periodic method, if you're standing on 30th April and you have to record the sales for these 10th April, so you will sell this 1st April wala first, right? You will sell this layer 1 first. Okay, now if you are following the perpetual method, so what will happen in the, on that date, on 10th of April, which one you will sell first? You will sell this one only, this one, layer 1 only. So even if you follow periodic or you follow perpetual, in both the situations, which one you are selling first? You are selling the layer 1 first. Now coming to the, what will be the total cost that is gonna be added or that will be sold. So these 400 units are being sold, so this is the FIFO, first in first out. So which one came first in your business? This one. So this 400 units at the rate 10, so 4000 will be sold off. So what will be the inventory balance? The inventory balance will be 600. How 600? 1000 were there, 1000 was there. Out of this 400 has been sold. So 600 is the remaining. What is the balance inventory? What is the balance inventory? First of all, from this layer 1, I have already sold 400 units now. So 100 at the rate 10 is remaining. 100 at the rate 10 is remaining. Then what else is remaining? The entire layer 2 is there. Entire layer 2 is there. So 6000 plus 1000, 7000 is my inventory balance. 7000 is my inventory balance that is remaining. Now coming to the next sales. Now when I am doing the sales again, I am selling 300 units and I am following first in first out, FIFO method of accounting. So from this layer 1, 100 units were remaining, 100 units were left because 400 we have already sold on 10th April. So 100 units which were remaining, that I am gonna sell 100 at the rate 10, that I am gonna sell, and in the, again 200 at the rate 12, 200 at 12, this I'm gonna sell. So 100 plus this 1000 and 2400. So how much will be my cost of goods sold? My cost of goods sold will become 3400. Okay, and what will be the balance inventory? So this layer 1 has already been entirely sold. This layer 1 I have entirely sold. From layer 2, how much we have sold? We have sold 200 units. So 300 units from layer 3 is layer 2 is pending. So 300 into 300 units is pending. 300 into 12, 3600. 3600 is the inventory that is pending. So layer will be layer 2 ka 300 into 12, that is the pending layer with us. Now again we have bought some inventory. Now the inventory which I have bought, it is 400 units at the rate 14, so the cost will become 5600 and the inventory unit balance will be 700. Why? Because this 300 inventory unit balance, this plus this will become 700. Now what will be the value of this inventory? The value will be this 5600 plus this one, plus 5600 plus this inventory value balance. So the 5600 plus 3600 will become 9200, because this is the last time ka balance which is there in my warehouse, and this is what which is newly added. So again we have layer 2 and layer 3 with us. How much is there from layer 2? 300 units from layer 2 is there. From layer 3, 400 units are there. Then coming to the sale, when I have the sales, when I am doing the sales, again first in first out. No, so from layer 2 I will sell, like you should look at this layer column. Whenever you are doing your calculation, just do the calculation like this. So when I have a look at the layer column, from layer 2, 200 units will be sold at the 12. So what will be the cost? 2400 of cost of goods sold. And how much will be the remaining? From 700, 200 is sold, so 500 is remaining. Now in this 500, 400 to pura is layer 3, pura this one is there, and then 100 units of layer 2 is there. So that means, let me do the math here for better understanding. From layer 2, how much is remaining? From layer 2, 100 units are remaining. 100 units are remaining, and what's the cost? It's given over here, 12. So this becomes 100 into 12, and layer 3 entirely is remaining. So layer 3, what was the price of layer 3? 5600. So this become 1200 plus 5600. 1200 plus 5600 will become 6800. So which are the layers remaining? Layer remainings are layer 2 and layer 3. Then coming to the sale. Last again we have the sale. We have the sale of 100 units. So layer 2 say 100 units was remaining. Layer 2 say from layer 2 100 units are remaining. So these will be sold at 12. So this becomes 1200. And what will be my inventory balance? This entire layer 3 has been unsold up till now. So how much will be my balance? This 400. And what is the value of this? 400 at the rate 14 each. So this 5600 will be my ending inventory. So my layer 1 and layer 2 is completely exhausted. Now if I calculate my cost of goods sold, where do I see cost of goods sold? This and this. This all will be my cost of goods sold. When I sum total all this, it will come to 11,000. And coming to my ending inventory, what is there in my ending inventory? This 5600. This 5600 is my ending inventory. And what is the sum total of this? The sum total of this is 16,600. So my total inventory was this much, and 16,600 from this 11,000 is allocated to COGS and 5600 to ending inventory. What is happening? Why in FIFO both periodic and perpetual are the same? You should see this way, that I am standing, even if I take the example of periodic. In the case of periodic, when I'll be standing on 30th April, if I'm standing on 30th April, what will happen if I'm following the FIFO? So whatever sale I have made on 10th April, that will be used from layer 1. Whatever sale I have made from 15th April, that will also be used from layer 1 and 2. And if I use the perpetual method, also, what will happen? Whenever I am selling, now suppose I am selling on this date on 10th April and I am updating my books of accounts. So as per 10th April, when I am which layer I'll be selling? I'll be selling layer 1 only. So that is why in both periodic and perpetual of FIFO method, we will get the same value. Now coming to the LIFO perpetual. Guys, please pay attention. This one is important. LIFO perpetual and periodic, both are important. First, we are doing the LIFO perpetual. What is perpetual method? In the perpetual method, we are doing what? We are selling off the goods. We are selling off the goods at the end. We are selling off the goods at the end. Sorry, not selling. We are updating our books of accounts at the end of the period. Now, what is happening? My total units is given as 500 bucks. My total units is given as 500. Now that what will be the total cost? Very simple, 5,000. What is the inventory balance? 500. What is the inventory value? 5,000. Which layer it is? This is layer 1. Now when I purchased 500 units at the rate 12 each, what is the total cost to add it? It is 6,000. Inventory units balance, it is 1000, because 500 was beginning inventory plus purchases. Then what is the inventory value balance? 500. 5,000 plus 6,000, it becomes 11,000. Then what is the layer detail? Layer 1 and layer 2 is given over here. So layer 1 and layer 2 both is there. Now coming to the sale, we are following the LIFO perpetual, last in first out, and that too perpetual method of accounting. So if I am following the perpetual method, I will update my books of accounts on this date, on 10th of April, right? So when I am standing on this date, I will be selling the one which I have recently bought. Which one was the last I bought? I bought this one. So I will sell it from this one. How many units are I'm selling? 400. What will be the cost? The cost which was there. So 4,800 will be my cost of goods sold. So what will be my inventory balance? From this 1,400 I am selling off, so 600 is my balance. Now this 600 which is there, this comprises of what? So this 400 I have sold from this, right? So 100 from this layer 2, 100 from layer 2, 100 from layer 2, I'll highlight this one, 100 from layer 2, and 500 entirely of layer 1 is there. So when I sum total this, I get 6,200. How did I get? I write down over there. I'll write it down, layer 1, layer 2. From layer 2, how much I have already sold? From layer 2, I have sold 400. Only 100 is there. at the rate 10 12. From layer 1, how much did I sell? How much did I didn't sell anything, so layer 1 is entirely there. So how did I get 5,000? And this becomes 1200. So 6200 becomes my inventory value. 6200 becomes my inventory value. Now coming to the total the sales value, if I talk about the sales, if I talk about the sales, what is happening? If I now talk about the sales, I am now selling the 300 units. If I am selling the 300 units, I am following the LIFO method. Now what is there in my inventory? I will sell the layer 2 first. So layer 2 may say 100 at the rate 12 will be there. Then from layer 1, from layer 1 how much should I take? I must take 200 at the rate 10, right? So this one will be 1200, this one will be 2000. So what will be my cost of goods sold? My cost of goods sold become 3200. This plus this, right? 1200 plus 2000 becomes 3200, my cost of goods sold. What is my inventory balance? So first of all, I have sold off I have sold off this one entirely. Layer 2 is completely sold off, right? What is my inventory balance? First of all, from 600 I have subtracted 300, so 300 is my remaining inventory. If 300 is my remaining inventory, which one is this? This one is the layer 1. This is the layer 1. So layer 1 is at what cost? The layer 1 is at 10 each. So 300 into 10 becomes 3000. So what will be the value? The value is the 3000. Layer 2 is already exhausted. Layer 2 has completely been sold off. Now coming to the purchases, a new layer has been added, 400 at 14. This is 5600, and my inventory unit balance is becoming 700. Why? Because 300 was previous one and 400 plus this one, so this becomes how much? This becomes 700. Then inventory unit balance will be calculated how? The value which is there in the previous date and the value which I have added, this plus this becomes 8600. This becomes 8600. So the layer detail if I take, so previously this one is already there, layer 1 is there, and what else is there? The one which is here, the layer 3 which we have purchased, that is there. Okay, how did we calculate? I'll write down here for you guys. So from layer 1 we have there, and from layer 3, layer 2 we have already sold entirely. Just follow the process, guys. So from layer 1, how much did we have? We have 300 into 10. And from layer 3, how much do we have? From layer 3, we have 400 into 14. So yeah, we were calculating over here the inventory value balance. So this one is entirely there, 5600. Layer 3 is there because it has been added, and then what is there in my ending inventory? 3000 is there. So that's why the sum total of these two will become 8600. Now when I am selling now. So what is happening? Since I am selling now, so what is this? LIFO perpetual. So what I am doing, I'll update my accounts here. I will update my accounting records here. So what will I sell? Which one will I sell? This one will I sell. This one I am gonna sell. So what is happening? How much is the selling one? So 200 units at the rate 14 I'll sell. So my cost of goods sold will become 2800. How much will be my inventory left? 700 minus 200. 500 is my inventory balance. And what will be my inventory value balance? My inventory value balance will be this much. How much it will be? This 8600 which is there. From this 8600 I can reduce this 2800. So if I do this, I will get 5800. I will show it to you guys. 8600, like this is also the method. 8600 minus 2800. 5800 will be the method, right? So this is how much? This is layer 1. In this, the layer detail is from layer 1. Entire layer 1 is there. the layer 1 entirely is there, and from this newly added layer, I have sold 200 units, so the 200 units are still remaining. Then lastly I am selling 100 units. Then again LIFO, last in first out, which was the newest layer, this one, and from this how much it is remaining, from this layer I can see 200 units are remaining, so 100 units I am selling off at the rate of 1400. And what is my inventory balance? My inventory balance will be 500 minus 100, 400. So my inventory value will be 4400, and this one will be my details. So my cost of goods sold, is given 4800, 3200, 2800 and 1400. My ending inventory will be how much? My ending inventory will be my entire layer 1 and 100 units from my layer 3. Now if I do the sum total of this, take sum total of the cost of goods sold and ending inventory, this one will be how much? 16,600. It will be total of 16,600. This is the same for FIFO and for LIFO. Now we'll start with LIFO periodic. Please pay attention, guys. So in now coming to the LIFO periodic, what is happening in LIFO periodic? So first of all, again same example is given over here, but in the LIFO periodic I am assuming that I am standing on 30th April and then I am doing the accounting. I am assuming I am standing on 30th April and then I am doing the accounting. I am standing on which date? I am standing on 30th April. Now first, what I am gonna do in case of LIFO periodic, I will just record all the purchases amount and I'll see how much is my beginning inventory, and then we'll start doing our sales, so it becomes really easy for us. So again, beginning inventory is clear, 500 into 10, 5000, balance is 500, inventory value balance is 5000. What is the layer? Layer is 500 into 10. Purchases again 500 into 12, 6000, balance 500 plus 500,000. What is the balance? It is 11,000. What is the layers? How many layers? Layer 1 is this much, layer 2 is this much. Now coming to the purchases will be my third layer. What is the total cost added? 5600. What is the inventory unit balance? It is 700. Then what is the inventory value balance? We'll calculate later on. I hope this is clear up till here to you guys. Now coming to the calculation, now when I am making the sales, when I am doing my sales on this date, when I am doing my sales on 28th of April, last in first out, so I am doing the accounting for this on 30th April. So as per 30th April, which is my last in, which I bought the last, this one, right? Which one I bought the last? Just a second, guys. Just a second, let me fix this. Okay guys, so now we'll see the LIFO periodic, and we have already filled in the detail for this purchases and the beginning inventory. So now when I have to record this particular sale, when I have to account for this sale on 10th of April, I will follow last in first out. But since I am doing my accounting on 30th April, as per 30th April, what did I purchase last? I purchased last this 400 units at the rate 14. So on 14th, on 10th of April, I am assuming that I am selling off this everything which I have purchased on 14th. So that means last in first out. Okay, so what is happening? Last in first out. So this is the last which I have purchased, and this I will be selling off entirely. So 400 into 14 will become 5600. 5600 will be my cost of goods sold. 400 into 14, this entire layer 3, this one, this one is being sold off on this, so this becomes my COGS. This becomes my COGS. Okay, this becomes my COGS. Now if this is my COGS, what is my inventory balance? My inventory balance will be 1000 minus 400. 600 is my inventory balance. And what is the value of the inventory? Inventory value we are not calculating. Why? Because it will become really complex. This is LIFO periodic. We are just calculating the cost of goods sold. Now I am calculating the cost of goods sold. I am already sold this entire thing. Now when I am there on 15th of April, on 15th of April again I will apply the LIFO method. What I have bought last? This layer 3, but this one I have already exhausted. This entire layer is already exhausted. This already has been exhausted for this one. This already has been exhausted for this one. Okay, now when on layer this particular layer has already been exhausted. Now when I am selling off, on 14th, on 15th I am selling this 300 units. This will be picked from there. Last in, which was the last in? This one, at the rate of 12. So 1200, 12 into 300, 3600. This one will be what? This one will be my cost of goods sold. This one will be my cost of goods sold. Okay, what will be my inventory balance? From 1000, from 600, this 300 is gone, so 300 is the remaining. This 300 is the remaining. See, inventory balance will be calculated this way from before the date, but the value we are calculating using the one which we have bought later on. Now, so that means this is already gone. So now when I am talking about sale on 25th of April, on 25th of April, what I am selling 200 units, and which is the last in after this? Last in is this layer 2, because layer 3 is already exhausted. So from layer 2, 200 I am selling at the rate 12 each, so 2400. So this will be my cost of goods sold. This will be my cost of goods sold. So from my layer 2, what did I sell? From my layer 2 I have sold, from my layer 2 I have sold this 300 and I have sold this 200. From my layer 2, this is being sold from my layer 2. This has been sold from my layer 2. So now what only I have? I only have my layer 1. So from line again I am following the last in first out. Since the last ones I have already exhausted, so I am remaining with this one. I have remaining with this one. I have only this one. So this one I am gonna sold 100 bucks, sorry 100 units at the rate 10 each. So this becomes 1000. This becomes 1000. This is the cost of goods sold. This is the cost of goods sold, right? This is my cost of goods sold. So now if I talk about my ending inventory, what is my ending inventory? From this 500, this 100 has been used, so 400 units are remaining at the rate 10 each. So 4000 will be my ending inventory. If I talk about my cost of goods sold, my cost of goods sold will be sum total of all this 5600 plus 3600 plus 2400 plus 1000. So this becomes what? This becomes my ending cost of goods sold, and my total will be how much? 16600. My total will be how much? 16600. Okay, I hope this is clear to you guys. I know it's a bit complicated, but see just one thing. In LIFO periodic, we are standing on 30th April and then we are calculating our inventory value which we are selling off. The cost of goods sold is being calculated that way. So that's why we are following whatever is being last, that I am selling off. Now coming to the moving average one is very different kind of a method, in which what happens in this method, every time we sell anything, every time we purchase anything, our average value, our average unit will change. Every time I buy or sell anything, not sell actually, every time I buy anything, my average value, my average cost per unit will change. So what is happening? 500 into 10, 5000. 5000 is my cost. Then what is my balance? 500 units. Then inventory value balance, again it's 5000. What is the value of one unit? 5000 divided by 500. 5000 divided by 500, 10 becomes this. Then coming to the purchases, Coming to the purchases, how much I purchased? 500 at the 12, 6000 I purchased. What is the balance? 500 plus 500, 1000 is my balance. Inventory value balance. Inventory value balance means what? Inventory value balance means how much we have. 5000 plus 6000, 11,000 we have. What is the cost of 1 unit? What is the cost of 1 unit? 11,000 divided by 1000, 11 becomes the cost of 1 unit. Now I am selling now, so I will sell at average cost. I have already calculated the average cost in my previous transaction, in my previous purchases. How much it is? 11. So 400 into 11, 4000 become 4400 becomes my cost of goods sold. From 1400 is being sold, 600 is my inventory balance. What is the value of the inventory? The remaining value is 600 into 11, 6600 becomes my inventory balance. And what is the cost? What is the average cost? It's again the same, the 11. Why? Because after a purchase we change the value, we recalculate the value, the average value, average cost of 1 unit. Now again sale will be the same at 11. Cost of goods sold will be 3300. Inventory balance, out of 600, 300 has been sold, so 300. Then inventory value, how much will be the inventory value? This 300 at the rate 11, so this becomes 3300. Moving cost, moving average cost will be the same, 11 only. Now I have bought goods worth rupees 14 each, 400 units, so 400 into 14, what is the cost added? 5600. 5600. What is the balance of the inventory? This 5600 plus 3300, this becomes 8900. 5600 plus 3300, 8900. And what is the balance? 300 plus 400, this 700 becomes the balance of the units. Now if I calculate the 1 unit ka cost, 8900 divided by 700, 12.714. 12.714 becomes the cost of 1 unit. 12.714 become the cost of 1 unit. Now what is the total cost of the sales? So now the average cost is this much, so 200 into 12.714, COGS is coming to 2543. What is the balance? How much units are remaining? From 700, 200 has been sold, so 500 is the balance. 500 at 12.714, this becomes 6357. What is the moving average cost? 12.714. Then coming to the total cost of the 100 units which we are selling, again the average cost is the same, 12.714, so it becomes 1271. Inventory units balance, it becomes 400. And the inventory value balance, how much will it be? The 400 multiplied by 12.714, so this becomes 5086. And the moving average cost is 12.714. Now what will be my cost of goods sold? My cost of goods sold is the sum total of all this. And my ending inventory is this much, ending inventory is this much. So my total is 16,600. My total is 16,600. My total is 16,600. So as you can see, this method, how easy it is. Okay, now let's move on to the weighted average periodic. Just one thing we should remember, whenever we are doing our purchases, whenever I am doing my purchases, my average cost is being changed. My average cost is being changed. First it was 10, then it became 11, then it became 12.714. So after each purchase, what will happen? My average cost will change. Coming to the weighted average. So in the weighted average, what I'm gonna do? In the weighted average, what I'm gonna do? I'm gonna calculate the one average which is gonna be used for forever. Now, what is the total cost added? 5000. Inventory balance 500. Inventory value is again 5000 because nothing is added. Weighted average we are not calculating here. Why? Because it will be calculated at the end. Now first I'll see again how much did I bought, how much did I buy? 6,000. 500 into 12, 6,000. Balance 5,000. Inventory value 11,000. Inventory value is how much? 11,000. 6,000 plus 5,000. Now after this sales, what, how much balance do we have? 1000 minus 400, 600 I have. Value I'm not calculating. Why? Because weighted average will be calculated later on. Then again from this 600, 300 I sold. How much do we have? 300 in hand. we have 300 in hand. Then how, again we bought 400 units at the rate 14 each. 400 at the rate 14 each. What's the total cost added? 5600. How much is the balance? How much is the balance? 300 plus 400, 700 is the balance. What is the value of this? 11,000 plus 5600. This becomes 16,600. This becomes 16,600. Now from this 700, 200 I have sold, 500 is the remaining. From this 500, 100 I have sold, 400 is the remaining. Now I have to calculate the average cost. I'll take the total of all the cost added. I will take that what is my balance of the inventory. So 16,600 divided by 1400. How did I get the 1400? 1400 is the total units in. So iska and iska, this one, these two. What is my total cost added and what is my units in? Total cost added divided by units in will give me my weighted average cost. This comes to 11.857. This comes to 11.857. What is the value of my inventory balance? How much is the balance inventory? 400 into 11.857. This comes to 4742.8. 4742.8. This becomes what? This becomes my ending inventory. Coming to my cost of goods sold, how will I calculate? How will I calculate my cost of goods sold? How many units did I sell? These many units I sold. How many are they? 1000. And what is my average cost? 11.857. So 1000 into 11.857. So 11,857 becomes my cost of goods sold. Ending inventory becomes 4742.8. So the sum total will become roughly around 16,600. This is my total cost added. It gets split between cost of goods sold and ending inventory. So what's the difference between moving average perpetual and weighted average periodic? Is that only difference is that in the case of moving average perpetual, after each sales my weighted average or maybe my average cost per unit keeps on changing. But in case of weighted average periodic, we see what is all we have bought in that year and what is the total cost added. So we divide the total cost with the units added in our business, and that's how we get the weighted average cost per unit. And whatever is being sold, we multiply it by weighted average cost and we get our values. So that's how we have calculated everything. I hope this is clear to you guys. Moving on to our PPT. Just a second. Okay, so we have discussed all the examples, only those examples, all of them same thing is given over here in your slides, which I have solved on Excel. Over here it's given in this format, so it's better to solve it on a tabular format. That's why we have solved it that way. So yes, that's all about this particular chapter. We have discussed each and every example which is given over here. Okay, all of this is given. Now summary and memory tricks has been given over here. That means which things you should remember and like how should it go, like, so that is given over here, like how you should remember the things. Then keywords which are given over here, that means what is the concepts that you should understand clearly in order to solve these questions related to this chapter clearly. Then one student confusion line is that student confuse physical flow of goods with cost flow assumption. They are not the same. Cost flows is an accounting convention only. So physical flow of goods is for the accounting purpose only. So the physical flow of goods is actually different, but the accounting convention is like something different. They should not exactly match always. Then how this topic can be tested: calculations, MCQs, scenario based, conceptual questions, mixed kind of a problems. Then application, analysis, recall, like you should be able to apply the concepts, you should be able to analyze the concepts. Then whatever you have remembered, you should be able to recall it. Then coming to the examiner twists and common mistakes that students make. So the examiner twists are that they can mix the FOB, like FOB shipping terms maybe with destination, or maybe FOB shipping point with the cutoff dates, like whether it's FOB shipping point and the goods is in transit, then in whose books of account should be recorded, these things. Then consignment goods, then like as we know, consignment goods, what happens, the goods are always recorded on the books of the consigner or on the books of the seller. Then COGS versus ending inventory, periodic, perpetual, then giving some irrelevant data just to confuse you. And how we can students get trapped in these examiner twists, that is we ignore the shipping terms when determining the ownership, then including the consigned goods in the wrong inventory, confusing the FIFO with LIFO, then forgetting the total cost must always match, that is total cost should always be equal to sum total of COGS and ending inventory, then mixing periodic and perpetual logic in the same question. So that's how it's about. Now some final exam thinking tips, that's how you should think in the exam. That first of all, check the total number of units available, then identify which system to use, LIFO or FIFO, then check the ownership status, that whether it is FOB shipping or FOB destination, then apply the right method, FIFO has to be used or LIFO has to be used. And finally, when you get your answer, the sum total of COGS and ending inventory should be equal to the total cost of goods available for sale. That is one thing. So if you follow all these things, this chapter will be very easy for you guys. And if you find any questions, any difficulty, please feel free to reach out to us and we'll be happy to connect and explain it to you guys. I hope you understood everything. Thank you so much.